Very good morning, my dear students. Welcome to the session on the indirect tax laws of the CA final. As you all know, we had started the chapter on input tax credit, one of the very critical chapters, one of the most important chapters from the examination point of view. The previous session was the first class on the input tax credit, where we discussed multiple provisions. We discussed the provisions on what are the conditions to be fulfilled for the purpose of claiming the input tax credit. Section 16 was an important section what we covered there. What are the documents on the basis of which the input tax credit can be availed? And we also saw some critical amendments with regard to claiming of input tax credit based on the amount which is displaying on the GSTR 2D. Correspondingly, rule number 36, sub-rule 4 also has been amended to that effect. And also that amendment also we have seen. Post that we went to section 17, which speaks about apportionment of input tax credit, and also the concept of blocked credits under 17 subsection 5, which speaks about the credits, even though if they are used for business, is not allowed from the GST point of view, like purchase of motor vehicle, food and beverage service, health services, membership and subscription, catering services, and multiple other services we have seen in our previous classes discussion. We also then went to the very intricate concept of the apportionment of input tax credit. As per rule number 42 and 43, we covered that. So 42 speaks about the input and input services, and 43 speaks about the capital goods. We went through those rules in detail and also worked out one particular problem based on that. So continuing from our previous session's discussion, a brief revision of 17.1 and 17.2. When are the situations which require the apportionment? First one, when it is used for business and when it is partly used for other purposes, that is number one. And the second one, when the goods or services are used partly towards taxable supplies and partly for making exempt supplies. Now, zero rated supplies are also covered in taxable supplies only. So please, we covered the concept of zero rated supply also in the previous session. So zero rated supply also has to be taken as the taxable supply when you are looking at the apportionment of input tax credit. So I hope this point is clear. Now, with regard to various sales promotion schemes, now any businessman for that matter will want to give lot of schemes so that his sales increase and for the purpose of marketing his particular product. So how do you treat the input tax credit in those cases? For this, a circular is there which gives a clarification with regard to various schemes. Schemes such as giving free samples and gifts, such as buy one, get one free offer, buy two for the cost of one offer, right? All these things, the clarification has been given. So first clarification was with regard to samples and free gifts. So therefore, if you see with regard to samples, which are given free of cost without any consideration, they don't qualify as supply. Why they don't qualify as supply? Because it is clearly exempt only when the activity falls within the ambit of Schedule 1. Can you tell me, can anyone tell me, let us see how your memory is. Can you tell me what is this ambit of Schedule 1? What does it say here? Regarding the samples for giving free of cost, what does Schedule 1 refer? Can anyone tell me? Good morning, Viraj. Good morning, Ramnata. Good morning, Sriram. Yeah, so can any one of you tell me what do you mean by this except where the activity falls within ambit of Schedule 1? I just want to test your memory and see where you are with regard to the previous sessions. Don't refer. If you refer, then your answer won't be counted. Don't refer. Without referring to Schedule 1, you have to tell me. Anyone? So in Schedule 1, it speaks about supplies without consideration. So when I say supplies without consideration, where I'm making the supply to a related person or a distinct person, in that particular point, even though there is no consideration, it is to be treated as a supply. So that means in case of samples, free samples and gifts, if you are making the provision of these to your respective related person or a distinct person, we have seen the concept very clearly when we discussed the concept of supply. So therefore, in this particular situation, if it is falls within the ambit of Schedule 1, then straight away you can claim the input tax credit also. Why? Because it's treated as a supply and you have to anyways pay the GST on that. So if it falls under Schedule 1, ITC can be claimed. But if the samples and gifts are given to persons other than related persons, there is obviously no requirement of collecting the GST from them. So in which case, you will not be eligible to the input tax credit. So I hope this point is clear. In that case, you will not be eligible to the input tax credit. If transaction is happening without consideration, that is the more important point, Janvi, here. Transaction is happening with distinct or related person without consideration. That is what is given in Schedule number 1. Anyway, it's good to see one answer, but others, if you have not answered, if you don't remember, there is cause for concern because you have to revise everything. Otherwise, you'll forget. It becomes a big problem for us. Otherwise, see, whatever we are spending so much time, we are spending hours together for each session. So the important point is you have to recollect and revise what we have done. The institute also has a very beautiful capsule at the end of each chapter in the study material which says, let us recapitulate. It hardly takes 5 to 10 minutes for you to read that. If you just read that, it is sufficient because you anyways know the concept. So when you just read that revision what the institute gives, it is more than sufficient. You don't need to go very deep and read everything because you anyways know the concept. It is only the question of matching the concept with what exactly is the section, right? So that was your sample and gifts. Then the next point what the circular wanted to clarify and address is with regard to the buy one get one free offer. Now, what do you mean by a buy one get one free offer? If I'm selling a toothpaste, along with that I give another toothpaste. So technically you cannot say that one is given without consideration and one is given with consideration. You can say that for both the toothpaste, that is one which is charged and one which is free of cost, a single price is being charged. So that means what? Let us assume a toothpaste is 50 rupees. A 50 rupees toothpaste, you are getting another toothpaste along with it. That means for both the toothpaste together, you are paying 50 rupees. You cannot say that the second toothpaste is given free of cost because you're paying something at the end of the day. You're not getting anything free of cost. So therefore, it was clarified that it was not an individual supply of goods, but a case of 2 or more individual supplies, where a single price is being charged for the entire supply. So for the entire supply, single price is being charged. At best, it can be treated as supplying 2 goods for the price of 1. Fine. And at the moment, it will be treated as supplying 2 goods for the price of 1. So ITC will be available to the supplier for the inputs, input services and capital goods used in relation to supply of such goods. So in this particular situation, even though you are getting buy one get one free, there is no question of disallowance of input tax credit. Input tax credit is allowed because you cannot say one is given free of cost. You can at the most say the 2 products are given at the price of 1. And the next one, discounts including buy more, save more offers. A lot of offers these days. If you see in any online e-commerce site, you will understand. You buy more and more, you'll get save more and more. Right? So in that particular situation also, ITC can be availed. There is no restriction whatsoever. So discounts including buy more, save more offers. In this case, discounts shall not be excluded while determining the value of supply. There is no impact of availability of ITC. So therefore, whenever you are determining the value of supply, you have to reduce the discount also because the discount is given upfront. There is no impact of input tax credit whatsoever. Now, when it is regard to secondary discounts as at the time of supply, you don't know the discount. After the supply is over, you discount. Such discount shall not be included while determining the value of supply. This you must have covered in the chapter dedicated to value of supply, wherein the turnover discounts or the incentive discounts which are given with regard to whenever the discount is given. You don't know at that point of time. Discounts such as when you achieve a particular sales limit, this discount is given. Such discounts also shall not be excluded. It will not be deducted from the value of the supply. Again, input tax credit availability impact. There is no impact on input tax availability. Fine. That was the circular which clarified with regard to discounts. Now we come to a second clarification which was given with regard to ITC reversal with regard of time expired medicines or drugs. This is also another clarification which was given. So in this particular situation, what is happening? This clarification primarily speaks about the pharmaceutical sector. So in the pharmaceutical sector, what happens? The manufacturer sells the drugs or the medicines to the wholesaler. And once it comes to the wholesaler, the wholesaler sells it to the retailer based on the invoice or the bill of supply, as the case may be. Now, whenever the wholesaler or the retailer receives the stock, and with regard to expiry date, if the medicines or drugs have expired, that is, the expiry date, usually it is there for 6 months or 1 year, depending from medicine to medicine. So now this, if medicines, the date is expired, then what he will do, the clarification was given that the retailer or the wholesaler can return the goods to the respective person. When he's returning the goods, he can treat the same as a fresh supply, or he can also issue the credit note to the extent of whatever sale has been made. So either he can show it as a fresh supply, or he can issue the credit note for that matter. So this is what is the clarification which is given by the circular. Fine. So wherever that person who is returning the time expired goods is a registered person, okay, at his option, he may return the said goods by treating it as a fresh supply and thereby issuing an invoice for the same. So therefore, what happens here? Where the person who is returning the goods, time expired goods, is a registered person, okay, in that particular situation, he will show it as a fresh supply, or return the goods by treating as a fresh supply and thereby invoicing for the same. Therefore, it is referred to as return supply. After that, what happens? The wholesaler or manufacturer, as the case may be, whenever he receives that return supply, he shall be eligible to avail the input tax credit subject to the conditions under section 16. Now, what happens if a case where the person who is returning the time expired goods is a composition taxpayer? We have seen what is a composition taxpayer. Now, here what happens? Let us take an example of a wholesaler and a retailer here. Okay, wholesaler sells the medicines or drugs to the retailer. Retailer is registered under composition scheme. That is, he does not collect the taxes from the customers. He just pays 1% of the turnover to the government. In that particular situation, the wholesaler sells it to the retailer. The retailer is registered under a composition scheme. The drugs have expired. Now, this retailer is returning the goods to the wholesaler. At that point of time, retailer cannot charge the GST. Why he cannot charge the GST, sir? Because he cannot charge the GST because he is registered under the composition scheme. In that particular situation, obviously, there is no input tax credit impact to the person who is receiving the return supply. So wholesaler is receiving the return supply, but there will not be any input tax credit effect for that because the retailer is registered under the composition scheme. So that was your section 16 and 17. Now we come to the discussion of section 18, which speaks about the credit in special circumstances, and we shall also see certain rules associated with section 18. So discussion of section 18 along with the rules will be a bit theoretical, but don't worry, this will not be tested theoretically in your exam. This theory has to be implemented in the problems what we are going to discuss. Problems can definitely be asked. So therefore, first we look at the section and the rules, which may be slightly elaborate. But once we go to the respective discussion of the section and once we go to the problems, don't worry, it will be crystal clear. Now, there may be a situation where a person who may be liable for registration. That is, his turnover has crossed the threshold. Now, let us assume for the purposes of our discussion, the threshold is 20 lakhs. Okay. Registration chapter, you will see in many cases the threshold is 40 lakhs also. But for ease of understanding and simplicity, let us take the threshold at 20 lakhs for our understanding. Now, 20 lakhs, whatever is the respective threshold limit, the moment a person's gross receipts cross 20 lakhs, straight away he'll be liable for registration. That means what? He has to get himself registered. In that particular situation, he will apply for the registration and he'll get the registration grant. The moment when his turnover crosses 20 lakhs, he becomes liable for registration. And that point of time, if he has any stock in his finished goods or semi-finished goods, he can claim the input tax credit of the same. That is what this particular section speaks about, right? So when the date on which you have to identify on which the input tax credit can be taken, whenever he becomes liable to pay the tax. When does he become liable to pay the tax? When he is liable for registration, right? But there's a condition here that he has to apply for registration within 30 days from the date on which he becomes liable for registration. Fine. So that was your section here. So therefore, let us now go look at the section. Application of registration where he becomes liable for registration. So person who has applied for registration under the Act, okay, within 30 days from the date on which he becomes liable to registration and has been granted such registration. So person who has applied for registration within 30 days from the date on which he becomes liable for registration. When does he become liable for registration? When his gross receipts cross 20 lakhs. And he has been granted such registration. So within 30 days he should have applied and he should have been granted such registration. He shall be entitled to take credit of input tax in respect of the inputs held in the stock and inputs held in the semi-finished or finished goods held in the stock on the day immediately preceding the date from which he becomes liable to pay the tax under the provision of the Act. So whenever he becomes liable to pay the tax, okay, that is liable for registration. The moment he becomes liable for registration, he becomes liable to pay the tax. So when he becomes liable to pay the tax, the day preceding that, you have to see the value of inputs in the stock, that is in the raw material. You also have to see the inputs in semi-finished or finished goods which are held in the stock. So whatever input tax you have paid on these particular items, you can claim as the input tax credit. This is your 18.1a. 18.1b looks at a situation of voluntary registration. So let me take you to 25 subsection 3 for a minute, which speaks about voluntary registration. What is voluntary registration? You don't have to get yourself registered under GST because your threshold is less than 20 lakhs. But you are facing an issue because these days one important critical issue which is being raised is due to the transparency of the GST registration, because any person's GST number, you can just locate it online. It has become that simple now. Everything is there public. So many customers are insisting for a GST registration so that the trust is developed in that particular taxpayer. So therefore, most taxpayers practically, without understanding the complications what the law gets along with it, get themselves registered under GST. Again, practically what happens, they don't file the returns. If you file the returns, they get suddenly surprised. My turnover is not 20 lakhs. Why I should file the returns? See, very simple. The moment you are getting yourself registered under GST, there is no question of any exemption. Your GST liability starts from the first rupee itself. When you are getting yourself voluntarily registered, the GST liability starts from the first rupee itself. So therefore, the moment you are registered, you have to pay the tax irrespective of the threshold. So this is what this talks about. In case of your registration under 25 subsection 3, voluntary registration, also the input tax in respect of inputs held in stock and inputs held in semi-finished or finished goods on the day immediately preceding the date of grant of registration. So here, whenever the registration is granted, so you applied for voluntary registration, you technically need not get yourself registered, but you want to get registered. You applied for voluntary registration, you got the registration certificate granted. Date of grant of registration you have to see. 1 day prior to that, whatever is the stock which is lying in your inputs and stock in finished or semi-finished goods, you can claim as the input tax credit. That is your voluntary registration. Fine. That is your 18(1)(b). Now we come to the third very, very interesting situation is the shifting from composition scheme to regular scheme. Now what happens in this case? Now this person is crossing the threshold of, he is a trader. He was applying in, he was there in the composition scheme, and later what is happening? He is shifted to the regular scheme because his turnover gross receipts crossed 1.5 crores. So he has come back to our regular scheme. So in that particular situation, what happens to the ITC? This is what is covered in 18(1) subsection C. Because even though he is under the composition scheme, he would have purchased a lot of material. He would have purchased a lot of inputs. In that particular situation, what is to be done? So therefore, here it says that where the registered person ceases to pay tax under section 10. So that is, he was registered under the composition scheme, but he ceases to pay the tax under section 10. That is, he is no longer eligible for the composition scheme. In that case also, he shall be entitled to take the credit of inputs, input services, and capital goods also. So important point, please make in stock and inputs in finished and semi-finished goods held in the stock. So therefore, 18(1)(a) and 18(1)(b) don't cover the capital goods, but 18(1)(c) covers the capital goods. Can anyone tell me what is the logic of not including the capital goods in 18(1)(a) and 18(1)(b)? Can anyone tell me what is the logic of not including the capital goods in 18(1)(a) and 18(1)(b)? And why suddenly in composition scheme you are including the capital goods? What is the logic? What is the intention of the law behind this provision? I hope everyone are there. Any answers? What is the intention of the law behind not including capital goods in 18(1)(a) and 18(1)(b)? You are present. Very good, Kaushiki. So I am asking you, just try to answer the question. The intention of 18(1)(a) of not including capital goods. I just want you to think in the morning so that you wake up, because early in the morning usually we tend to be a bit drowsy. I don't want that to happen. That is why I'm asking you questions. Because capital goods were purchased when he was not registered under GST, correct only, but inputs also were purchased. Inputs which is there in the stock also is purchased when he is not registered under GST. Composition scheme registered under GST has used that capital goods for business. Yes, to the some extent you're right. So with the moment you are registered under composition scheme, you have used that particular product for the business. That is why the facility is given. Whereas in the first two cases, you have purchased the capital goods, but there is no proper way to ascertain whether the capital goods have been used for the purpose of business or not. That is why the government does not allow this facility for these two. Whereas in the composition scheme, he is registered under GST. He's purchased that capital good under the with the GST number of whatever he had in the composition scheme. So therefore, the process is more transparent. So therefore, this one is that, and the date what says that, and on the capital goods on the day immediately preceding the date from which he becomes liable to pay the tax under section 9. So when does he become liable to pay the tax under section 9? when his turnover crosses 1.5 crores. Okay, the moment when his turnover crosses 1.5 crores, or when he himself has opted for the regular scheme once again, in that particular situation, whatever product, the date from which he becomes liable to pay the tax, the date preceding that date, whatever stock is there of inputs of finished, semi-finished goods, and on the capital goods, whatever input tax is there, he can claim the credit. But there is a provision which says here, the credit on capital goods shall be reduced by such percentage points as may be prescribed. Obviously, if you are purchasing a capital goods for 2 years, you are using it, and after that you are converting to the regular scheme, you cannot take the input tax credit of the capital goods what you purchased at that point of time. There has to be a depreciation element whenever it is capital goods. So therefore, to that extent, the depreciation benefit has to be given, and it will be reduced by such percentage points. Next, 18(1)(t). This also very, very interesting. Exempt supply becoming taxable supply. One supply was there. That supply now was exempt at one point of time. Later, it became taxable. So whatever stocks are there and whatever capital goods are there, you can claim the input tax credit. But a small wording difference between 18(1)(d) and 18(1)(c) is with regard to the capital goods, where you say the word exclusively used for exempt supply. That is, stocks related to exempt supply, and on capital goods exclusively used for such exempt supply. Why this phrase is there? Because obviously, in case of your capital goods for taxable supply, you would have already claimed the input tax credit. So only that particular capital goods has to be taken into consideration. So what does 18(1)(d) says? Where an exempt supply of goods or services or both by a registered person becomes a taxable supply, such person shall be entitled to take the credit of input tax in respect of the inputs in stock, inputs in finished or semi-finished goods held in the stock relatable to such exempt supply. Again, the stock on which he is claiming the input should be related to the exempt supply, and also on the capital goods exclusively used for that exempt supply on the day immediately preceding the date from which the supply becomes taxable. So whenever the supply becomes taxable, one day prior to that, whatever stock is there, on that he can take the input tax credit. Here also similar provisions there, provided the credit of the capital goods shall be reduced by such points, such percentage points as may be prescribed. Because capital goods are purchased for long time, here depreciation may have been claimed, correct? ITC not available, but for composition, no ITC. Hence they claim the depreciation. Hence, when shifting to regular scheme, the law allows them to take the ITC on capital goods. Correct? You're right. Maybe in 18(1)(a) and 18(b), government has not received any tax. Fine. Done. So that was our 18(1)(d). Then there are some other sections in section 18 which speaks about no input tax credit after 1 year of issue of the invoice. So in case of subsection 1, you cannot, the registered person shall not be entitled to take input tax credit under 18 subsection 1. So with regard to supply of goods or services or both, after the expiry of 1 year from the date of issue of tax invoice related to such supply. That means any supply of goods or services is there, you cannot take the input tax credit after the expiry of 1 year from the date of issue of tax invoice relating to such supply. So therefore, there is a time limit which is given here. That is, if 1 year has elapsed from the date of tax invoice, you cannot claim the input tax credit. So you have the various stock of inputs, semi-finished goods, capital goods, etc. Right? So important point here to remember is the invoice of that, it should be less than 1 year prior to that event what is happening. So after the expiry of 1 year from date of issue invoice, you cannot claim the input tax credit. 18 subsection 3 speaks about transfer of unutilized ITC in case of change in constitution. Now there may be a lot of changes in constitution, like a sale of the company or merger, demerger, amalgamation, etc., with a specific provision for transfer of liabilities. Right? In that particular situation, the registered person shall also be allowed to transfer the input tax credit which remains unutilized to such sold, merged, demerged company, etc. So if you have the ITC in the credit ledger and the constitution is being changed due to a merger, demerger, amalgamation, etc., what you will do is you will transfer the whatever unutilized input tax credit is there. You will transfer that to the respective electronic credit ledger of the merged amalgamated entity. 18 subsection 4 is a reverse situation. That means a person who is under a regular scheme, he opts for the composition scheme, or he is in the taxable supply and the goods have become now exempt. Goods or services have become exempt. Then the law expects him to pay some amount with regard to the input tax credit what he has availed. What is that? So where any registered person who has availed of input tax credit opts to pay tax under section 10, or where the goods or services are both supplied by him become wholly exempt. So I hope you understand two cases covered here. First is he is basically a regular registered person. He wants to opt for the composition scheme, so he has changed to the composition scheme. Or whatever the goods or services he was providing now has become exempt. Earlier it was taxable. Then he shall pay an amount by way of debit to the electronic credit ledger or cash ledger, equivalent to the credit of input tax in respect of inputs held in stock and semi-finished goods, and on capital goods reduced by such percentage points on the day immediately preceding the date of exercising the option or the date of such exemption. I hope it is clear. So whenever you are exercising the option to convert to the regular scheme, whenever you are exercising the option for registering under the composition scheme, the day prior to that particular date, whatever stocks are there on that particular stock, you can pay the amount of the electronic credit ledger equivalent to whatever credit you have claimed. You will pay the amount by way of debit in the credit ledger, provided after the payment of such amount, the balance, if any, shall lapse. So you have to first calculate that and pay that amount. Still after that also in the electronic credit ledger, if any amount is there, it will lapse because he is not eligible to any particular input tax credit now that he is under the composition scheme or he is now engaged in the exempt supply. Right? So amount of credit in subsection 1 and amount payable under 4 shall be calculated in such manner as may be prescribed. This is where the rules come into the play. In the rules, very in the elaborate way it is given as to how you should do the working. Based on this only the problems will be asked in the examination. Then 18 subsection 6 speaks about in case of supply of capital goods or plant and machine. What does this mean? You have purchased a capital goods for the business. You have used it in your business for a period of time. Later you want to sell this capital goods to someone else. So what has to be done? There in this particular thing, there is a provision 18 subsection 6 which says that in case of supply of capital goods or plant and machinery on which you have already claimed the input tax credit, the registered person shall pay an amount equal to the input tax credit taken on the said capital goods or plant and machinery. Okay, with regard to how much ever input tax credit has been taken, to that extent the registered person shall pay the amount reduced by such percentage points as prescribed, or the tax on the transaction value of such capital goods or plant and machinery determined under section 15, whichever is higher. So what happens? See, it's very simple. Let me take an example here to make you understand. Here, capital goods are there. You have purchased for, say, rupees 1 lakh, GST at 18%. Has been, that is rupees 18,000 has been claimed. Okay, goods are purchased on goods. This capital goods purchased for, let us take a date on, say, 1st October 2022. Okay, this capital goods have been sold on 30th April 2020. Okay, now you have claimed input tax credit of 18,000. Okay, so what does the rule say here? You have to pay amount equal to input tax credit as reduced by the percentage points. Percentage points we will see, basically it is 5% per quarter is the amount. So whatever 18,000 you have quarter, October, November, December, 3 months is there. Then Jan, Feb, March and April. So again here also as may be prescribed. So in the rule, you'll see the 5% per quarter issue. So 5% in this also, there are 3 quarters, same part thereof you have to take. So 15% you have to reduce from 18,000. You have to compare that figure, or 18% of rupees 75,000. So two options. So first one is rupees 18,000 reduced by 15%. Please calculate and see how much is the coming. 15% of 18,000 you have to take. Reduce it from 18,000. What is the value? Or 18% of rupees 75,000. Okay, because that is the transaction value. That is what is your 18 subsection 6. Whichever is higher, you have to take, right? But there is a provision which is given where refractory bricks, molds and dies, jigs and fixtures. Okay, these are all like accessories which are supplied as scrap. In that particular situation, there is no question of this input tax credit and all. You have to, he can pay the tax on the transaction value of such goods determined under section 15, because these are all sold as scrap. A lot of accessories and all are there where they sell it as scrap. He can pay the tax on the transaction value as determined under section 15. Fine. I hope you understood this point. We'll also work out a problem based on this. We'll work out problems based on all the sections. Don't worry. You'll get full clarity with regard to the thing. Same. Okay, some doubts. Very nice. Sir, but if the left out inputs which are greater than 1 year time from the date of issue, date of invoice can be claimed till 30th September following the end of the financial year. But as per section 18.2, it is in conflict of the above provision to claim left out credits. See, when you're talking about the section 16, which says that you can claim up to 30th November, you're not looking at a transition. You're not looking at a transition from the composition scheme or regular scheme, etc. You're looking only at a regular scheme only. But here in this particular situation, you're looking at a transition. You're looking at a transition from the non-registration to registration or composition scheme to regular scheme. So in that particular situation, there is no question of input tax credit claim. So only once that person gets into the regular scheme or this person gets himself registered under GST, the financial year begins with regard to claiming of input tax credit, then the time limit of 30th November will apply. But in this particular situation, 1 year invoice, 1 year from the date of issue of the invoice, why is he mentioning? Because in that 1 year from the issue of invoice, he was not registered under the regular scheme, or he was not registered at the first place. So there is no significance of the 30th November. So therefore, both the provisions are totally separate. They are not in conflict with each other. I hope you got the point, Shriram. Sir, you told we have to claim ITC as per 2B, but if R1 is not filed on the due date, then we can't claim ITC. Then how we can claim within 1 year from the date of issue of invoice? Please bear in mind, with regard to this particular this is a transitional ITC what we are seeing. In this particular situation, whatever ITC is there, okay, whatever ITC is there, we have to value the ITC. Once you look at the rules, it will be more clear. You have to file one form with the GST department, ITC 03. In that, you have to indicate what is the ITC is claiming. The ITC, what we are discussing in this particular section 18 does not have anything to do with 2B. Okay, does not have anything to do with 2B, because this we have to value the inputs in the stock. We have to value the capital goods. From there, we have to reduce the respective percentage points and claim the respective ITC. This is as per the rule what we have to do, the separate procedure altogether. This does not depend on the GSTR1 filing and the 2B and all, because that will come only once you are in the regular scheme or once you become registered under GST. Once you see the rules, you'll be able to understand. Now we come back to 18 subsection 4. 18 subsection 4 is very simple. I'll tell an example so that then you will understand better. See, first thing is this person now, he is in the composition scheme. Let us first take case 1. Case 1, okay. Mr. A is registered under composition scheme. Okay. That means what he's doing? Okay, he's a trader. Let us assume he's a trader of furniture items and pays 1% of the sale value under section 10. Okay, this is what he's doing. Now, this person, he registered, sorry, it's a different. He is registered under regular scheme. 18 subsection 4, we wanted clarification. Mr. A is registered under regular scheme. Okay, again, he is a trader of furniture. He is a trader of furniture with effect from 1st April 2023. He has now migrated to composition scheme under section 10 and now pays 1% of total sale value as tax. Okay, this is what he has done. Now let us go to the section. What does it say? I'm looking only at case 1, so forget about this one for that matter. We are looking only at this one. Now, okay, this person, Mr. A, has ITC of rupees 75,000 in electronic credit ledger. Okay, electronic credit ledger he has, because he has all the inputs etc. of the stock. He has the stock with him. Okay, he has the stock with him. How do you value the input? That is what we have to see. Whatever stock he has at that point of time of inputs, stock which he has when he migrates to that scheme. So on the date immediately preceding the date of exercising such option, so ITC of 75,000 he has in the credit ledger, or he has stock of inputs in finished or semi-finished goods. Okay, as on 31st March 2020. I hope you got the point. See, when you are in the composition scheme and you are purchasing any particular product and you give the GST number, the credit will appear in 2B and you will reverse it. You cannot claim that as such. So the possibility of the amount being in the electronic credit ledger is very rare. It may be for that particular month. Or you have stock as on 31st March 2020. Then what you have to do? If you have stock, value the ITC on the stock and pay the respective amount. He is registered under regular scheme. Whatever input tax credit he has claimed will be there in the credit ledger. If he is utilized that in the regular scheme itself, that won't be there. But assuming he has purchased some goods in the regular scheme, amount of that ITC 75,000 is still there. He has nothing in the input tax credit, but he has stock with of the finished or finished goods. In that particular situation, you have to value the respective ITC and pay that respective amount to the department. Pay the respective amount to the department. Okay, so therefore, if you understand here, he shall pay an amount by way of debit in the credit or cash ledger equivalent to the credit of input tax held in respect of inputs in stocks and finished goods, reduced by such percentage points as may be prescribed. So you have claimed the input tax credit. It is there in the credit ledger. You have to pay and you have to nullify that. Why you are supposed to nullify that? Because you are going to the composition scheme. The moment you are in the composition scheme and those stocks are there with you and you have claimed the input tax credit, you are not eligible to that credit henceforth. That is why to that extent you have to pay the respective amount. I hope this point is clear. Sriram had asked, I think. I hope this point is clear. Now, okay, it is basically this shifting from the regular scheme to the composition scheme. Case 1 is the similar. Case 2 is again similar. Wherein here what is happening? You are shifting from the goods become exempt. You see here, the second one, the goods or services supplied by him become only exempt. So case 2 is taxable supply becoming exempt. In this example, I cannot understand why 18% of 75,000 to be calculated. Once look at the let us look at the example. 18% of 75,000 will not be calculated because 75,000 is 18% itself. 75,000 itself is the ITC. I hope you got the point. Don't get confused here. Very clear. 75,000 is the ITC itself. So if 75,000 relates to the stock of the finished or semi-finished goods, entire 75,000 will be paid. Nowhere we have mentioned that 18% of 75,000 will be paid. 75,000 is the ITC. To look at the example, let us look at the example here. 75,000 he has in the electronic credit ledger. Okay, so if he has the electronic credit ledger, that means the 75,000 itself is the 18% what he has paid on the stock. Okay, I hope it is clear. Sir, I am a tax consultant. I have purchased a laptop of 1.5 lakhs. Can I claim ITC of capital goods? Yes, you can claim. If I purchased Bajaj Pulsar worth 1.9 lakhs, can I claim ITC of Bajaj Pulsar? Motor vehicle transport, motor vehicle clearly blocked credit, it is there. You are utilizing it for the purpose which is clearly blocked under 17 subsection 5. It comes under motor vehicle, you cannot claim the input tax credit. Sir, I have not registered under GST. After purchasing laptop, I wish to register under GST. Can I claim ITC? See, again, go back here. You are not registered under GST. So my question, Viraj, is your turnover crossing 20 lakhs? Are you liable to be registered? Or you are getting a voluntary registration done? If you are getting a voluntary registration done, go to this one, 18.1b. Okay, 18.1b. So you purchase a laptop. After you purchase the laptop, you get yourself voluntary registered. If the but again, a laptop is a capital good. The moment the laptop is a capital good, you will not get any input tax credit under 18.1b. Clear? It is before 1 year, we can't claim the yes. Yes, you have got the point correctly now. Okay. I hope all of you have got the clarity regarding all these provisions. Don't worry, once we see the rules and do problems, things will be more clear. I've given examples for you as of now to understand the thing. Still, if you have any queries, please keep shooting on the query link. We will definitely address all of those queries so that you get total clarity. Getting clarity of section 8 and the rules is very, very important, because only if you have the clarity, you will be able to work out the problems. So now we come to rule number 40, which covers the claiming of credit in special circumstances. So here the various rules are specified as to how you have to claim the input tax credit or how you have to reverse the input tax credit in various situations. The first one, what we see is the input tax credit, whatever is claimed as per the provisions of section 18.1 on inputs held in the stock or inputs in semi-finished or finished goods or capital goods in C and D. Okay, A and B capital goods is not there. So shall be subject to the following conditions. So what are the conditions? First one, as I told you, ITC on capital goods with regard to 18.1C and 18.1D shall be claimed after reducing tax paid on such capital goods by 5 percentage points per quarter. I've already told you this. We worked out an example also. 5 percentage points per quarter from the date of invoice or such other documents on which the capital goods were received by the taxable person. Second one, these are the rules for claiming the input tax credit. Because your GSTR 1-2B matching is not happening yet, these are the rules what you have to claim. Within a period of 30 days, whenever you become eligible for input tax credit, under 18 subsection 1, if you have delayed that period, you may apply for condonation of delay. Sometimes the delay may be condoned and you can still file it. You should make a declaration electronically on the common portal in GST ITC 01. This is the form which is required to be filed, wherein in the declaration you will mention that you are eligible to avail the input tax credit. Okay. In any extension of time limit needs to be notified by the commission. What all shall the declaration specify? Whatever the declaration you are given under clause B. shall specify the details relating to the inputs in stock, inputs in semi-finished or finished goods, or as the case may be, capital goods. Okay, all the details have to be clearly there. What is the date of the invoice? What is the value of the inputs? What is the GST paid on that? Okay, with regard to 18(1)(a), the day preceding the date on which he becomes liable to pay the tax. That is registration part. Second one, day immediately preceding the date of registration in case of voluntary registration. Third one, day immediately preceding the date from which he becomes liable to pay the tax under Section 9 in case of claim under 18(1)(c). Okay, this is your shifting from composition scheme to regular scheme. Then on the day preceding the date on which supplies become taxable, this is exempt to taxable supply. So whatever details of the inputs are there, the declaration has to clearly specify. This declaration has to be certified by a chartered accountant or a cost accountant if the value of the claim exceeds 2 lakhs. So whatever value of the claim is there, if it is exceeding 2 lakhs, then it has to be duly certified by a practicing CA or a cost accountant. Okay, so the ITC claimed in accordance with provisions of 18(1)(c) and 18(1)(d) shall be verified with the corresponding details by the in form GSTR1 or as the case may be in GSTR4. So in case of C and D, because C and D, what is happening? If you're there under the composition scheme also, you have a registration number. So in that case, you will also verify with the GSTR1 whether those particular items were purchased from the respective supplier. Then the amount of credit in supply of capital goods or plant and machinery again shall be calculated by reducing input tax of the said goods at the rate of 5 percentage points for every quarter or as the case may be from the date of issue of invoice of such goods. So that was your rule number 40 with regard to how to calculate the credit in such cases. Sir, I have asked the doubt on 18% of 75 not in composition scheme. Example in 18 subsection 6, you have pointed out to reduce 5% per quarter or rupees or 18%. That why should we reverse 18% on sale value? Oh, you had asked the doubt for that one. Okay. 1 second. Let me go there. See, here what you are doing, you are purchasing the capital goods 1 lakh. You are claiming the respective input tax credit, and this capital goods you are further selling for 75,000. Okay, these capital goods have been further sold for 75,000. So in that case, the law says that you have to pay the input tax credit, whatever you have claimed earlier, as reduced by the respective percentage points or the tax on the transaction value, whichever is higher. Need to understand. So this 18,000 is what? When you claim the credit of the purchase of capital goods. From this 18,000, you will now reduce 5% per quarter. Okay, when you are selling it in 30th April. So what are the quarters which are covered here? October, November, December, 1 quarter is covered. Jan, Feb, March, 2 quarters are covered. April, May, June, part thereof, that also 3 quarters are covered. Till now, I hope you followed. This 3 quarters, 5% per quarter, 15%. So 18,000, just calculate once, 18,000 with the calculator will do, then you'll get more clarity. 18,000 into 15%. Okay, 2,700. So 18,000 minus 2,700, 15,300. Okay, which comes to rupees 15,300. This is A. Let us assume this is A. Okay. Or 18% of 75,000. What is 18% of 75,000? Why you are taking 18% of 75,000? Because you are selling it for 75,000. This comes to rupees 13,500. Let us assume this is to be B. A or B, whichever is higher. A or B, whichever is higher, is to be paid. Shriram, I hope you got the clarity on this. Rule 40D. No problem. We'll go there. It's very simple. This rule number 40D, wherever the claim is more than 20 lakhs. See, this A, B, C, you have to clearly give the details. Okay. You have to see all this, specify the details relating to the inputs held in the stock. Now, if these details are more than 2 lakhs, then whatever you are claiming, you need to attach a declaration to the online claim. You need to attach a declaration. In that, you will say that the following are my inputs on which I'm respective claiming the credit. So if it is more than 2 lakhs amount, the total amount is more than 2 lakhs, aggregate value of total claim is more than 2 lakhs, the declaration has to be certified by a practicing chartered accountant or a cost. Okay, I hope that is also clear. Sriram, understood? Very good. Fine. So that was your 40. Now we come to rule number 41 with regard to transfer of credit on sale, merger, amalgamation, lease or transfer of business. So these are also with regard to sale of business, merger of business, demerger, amalgamation, etc. He will furnish the details of all that in form ITC 02 along with a request of transfer of unutilized credit, because you're transferring the credit from one person to the other here, because the moment you merge, the moment you amalgamated, you become another person altogether, and you get a separate GST registration for that. So here what happens, whatever unutilized credit is there in this ITC 02, you have to give the details and you have to transfer it to the new person. With in case of demerger, the input tax credit shall be apportioned in the ratio of the value of the assets of the new units as specified in the demerger scheme. What does the demerger do? The demerger splits one entity into multiple entities. So multiple entities have their own assets. So this one entity input tax credit in case of demerger has to be split to the multiple entities in proportion to the assets, value of the assets owned by them. Okay, so value of the assets means value of the entire assets, whether or not the input tax credit has been claimed or not. So here in this particular situation, when you are calculating the percentage of for the demerger, you have to take entire assets into consideration. Here also, chartered accountant or cost accountant is there certifying that it has been done. Here there is no monetary limit. Certificate is compulsory that it has to be done. Specific provision for transfer of liability. So this point has to be clearly mentioned in the certificate, saying that what this demerger or this amalgamation has been done, the provision for transfer of liabilities. So then what happens? The transferee, that is the person, the new entity which is formed, will accept the details furnished, and whatever unutilized credit is there will be credited to the electronic credit ledger. Fine. And whatever inputs and capital goods shall be duly accounted in his books of account. Now we come to rule 41A. When you are getting a separate registration for multiple places of business, what happens? So when you are obtained the separate registration for multiple places of business in accordance with the provisions of rule 11, and rule 11 says that in case you are registered, in case you have businesses in different states, and your threshold of the PAN level threshold process 20 lakhs, you have to get registration. This you will see in a more clearer manner in the registration topic. Okay. Now what happens here? One registered person is there. He has obtained separate registration for multiple places. Whatever unutilized credit he has, he wants to transfer it to the newly registered places of business, because that pertains to that particular state. Now let us take an example here. I am registered in Hyderabad, Telangana, and I have opened now a new office in Bangalore, Karnataka. Okay, now I have procured certain products. These products I want to sell it in Bangalore. So whatever input tax credit I have presently claimed it in Hyderabad and kept it with me. So this ITC also I can transfer it to my Bangalore registration or any other state registration also, whichever you are planning. For that also the law allows the facility. In that particular situation, whatever credit you want to transfer within a period of 30 days from obtaining the separate registration, the details in ITC 2A has to be filed either through facilitation center notified. And here either directly you can file or through a facilitation center, provided input tax credit shall be transferred in the ratio of the value of assets held by them. You have to see what is the assets which are held by the new registered entity. To that extent only the credit will be transferred. Similar explanation is given that whether or not input tax credit is taken, of assets should be there. Then once the transfer happens, the newly registered person will accept the details and unutilized credit shall be created in the electronic credit ledger. So that was your rule 41A. Now we come to rule number 44, manner of reversal of credit under special circumstances. As I told you, this is the vice versa situation, wherein in case of 18 subsection 4 or 29(5) cancellation of registration, what happens? Whatever amount of input tax credit which is there relating to the inputs, etc., shall be determined in the following manner. So, where the inputs are held in stocks and inputs contained in semi-finished and finished goods, the ITC will be calculated proportionately on the basis of corresponding invoices on which credit is there. So, see, very simple. If you have the inputs which are there in the stock, you want to reverse the credit based on the invoices on basis of which you have claimed the input tax credit. You are supposed to work out the respective input and pay that. And for capital goods, you have to take it on a pro rata basis, taking the useful life, assuming the useful life as 5 years. That 5% per quarter, how is it come? 20% per year. So useful life is 5 years. So that is how that 5% per quarter has come. Then whatever amount you have to determine separately. Then sometimes what happens, the tax invoices of the inputs may not be available. Then he will estimate the amount as per the prevailing market price or on the effective date of occurrence given under 18.4 or 29.5. Whatever amount is there will form the output tax liability. So whenever this shift from regular to composition or taxable to exempt happens, you will work out the whatever output tax liability, and this liability will be furnished in ITC 03 and any event in 18.4 or GSTR 1, which where such amounts related to cancellation of registration. So even cancellation of registration also, where you are no longer required to pay the tax, whatever goods inputs are there, whatever credit is there, you are supposed to reverse that and get it paid. And these details also have to be certified by a practicing chartered accountant or a cost accountant. Then how do you determine the input tax credit for capital goods? Same way, how you have done that 5% per quarter has to be taken into consideration. Where the amount determined is more than the tax determined, the amount determined shall form part of the output tax liability. Same shall be furnished in GSTR 1. This is exactly the example what we covered now, that 13,500 and 15,200. Wherever you have to see tax on transaction value plus that after reducing, reducing the 5% per quarter, whichever is higher that you have to pay, and you also have to file this return in GSTR 1. So that was your rule number 44. Input service distributor is different. Input service distributor will cover now next. That is the next point what we are going to cover. So what we covered now is one registration person. If he is going for separate registration, that he can transfer. Input service distributor is different. Input service distributor will basically already multiple places of registration will be there. Separate registration as an input tax input service distributor needs to be taken into consideration, and that input service distributor will calculate what is the credit to be distributed across each persons. Facilitation center means if you are not able to directly file, the government has set up multiple facilitation centers, physical support centers for GST, like GST Suvidha centers and all. So there you can go and submit the respective application. So what does section 18 for? Let us go through section 18. The summarized section 18 important points here is entitlement of ITC on inputs in stock and contained in finished goods at the time of voluntary or registration or voluntary registration, on coming into regular status by exiting composition scheme, or coming into tax paying status on account of exempt supply becoming the taxable supply. That is first one. Entitlement of ITC on inputs in stock and finished goods. Then reversal of ITC on inputs in stock and contained in finished goods or work in progress and capital goods. So two things. First is entitlement of ITC. Second is reversal of ITC. So inputs is there in capital goods and there in finished goods or work in progress. Once you are exiting from regular scheme to composition scheme, or you are exiting from tax paying status, that is a taxable supply becomes exempt supply. It talks about reversal. So first is entitlement of ITC. Second one is reversal of ITC. And then amount payable on the capital goods, on plant and machinery on which we have paid the ITC, change in constitution, transfer. So these four are the, in brief, the various situations which are covered in section 18. This table will put things very, very clearly. This table, take a screenshot or I'll anyways send the material. But this you keep this very, very carefully, very, very important for you to understand. There are persons eligible to claim the credit. First one is when he becomes liable for registration, that is turnover crosses 20 lakhs, he applies for the registration and grants the registration. In that case, two things are important. On what you can take the inputs? You can take inputs only inputs held in stock, semi-finished or finished goods held in the stock. You will not get the input of capital goods. What is the date which is important? The date immediately preceding the date from which he becomes liable to pay the tax. When does he become liable to pay the tax? When his turnover crosses 20 lakhs. He becomes liable to pay the tax then, there and then. So that date you have to see. Before that, whatever date is there on that stock is there, you can take that into consideration. Second one is who is not required to register, but he obtains the voluntary registration. Again, good inputs held in the stock, inputs held in semi-finished or finished goods, you can claim. What is the relevant date here? Whenever the date of registration is granted, 1 day prior to that date, the respective inputs can be taken. Again, what are the conditions here? ITC has to be availed within 1 year from the date of issue of the tax invoice by the supplier. Okay, you have to, that invoice should be within 1 year. Then the third and fourth cases is first the registration, first who ceases to pay under the composition scheme shifts to the regular scheme. Here, apart from inputs, you can get the claim of capital goods also. And what is the date? Immediately we have to see whenever he becomes liable to pay the tax under regular scheme. That is, your turnover is crossing 1.5 crores. Whenever he becomes liable to pay the tax under the regular scheme, the day immediately preceding that date, the date preceding that date, you have to take into consideration for valuing this. And then the fourth case, registered person whose exempt supply becomes the taxable supply. Then again, inputs have to be considered. Capital goods exclusively used for exempt supply has to be considered. The day preceding the date on which it becomes liable, that date you have to take into consideration. What are the restrictions or conditions here? Capital goods ITC will be reduced by 5% per quarter. We have already seen that. Whatever ITC you have claimed will be verified with the corresponding details furnished by the supplier. Within 1 year from the date of issue of tax invoice of the supplier, the ITC has to be availed. So these tables is very important. This table and this table, please, once you read that, you'll be able to understand very clearly. Again, declaration has to be made, registered person. Declaration has to be filed within 30 days. Again, there's a time limit for the declaration to be given. Within 30 days from the date on which he becomes eligible to avail ITC, he has to file the declaration. The claim of ITC, if it is more than 2 lakhs, the declaration has to be certified by CA. Fine. Example, Mr. Z becomes liable to pay the tax on 1st August, has obtained registration on 15th August. Is Mr. Z eligible to claim the credit on inputs and capital goods? Try to answer this question. Similarly, this one, Mr. B, a registered taxable person, was paying tax at composition rate up to 30th July. However, with effect from 31st July, Mr. B becomes liable to pay the tax under regular scheme. Comment on the eligibility of ITC of Mr. B. So the first Mr. Z and Mr. B, both this try to answer. Stock held on 31st July. Read the question carefully. Is Mr. Z eligible to claim credits on inputs and capital goods? Read the question carefully and again answer. Our Namrata. Read the restriction also. On stock held on 31st July, inputs and capital goods both are given. On inputs you can claim, on capital gains you cannot, capital goods you cannot claim. Okay, because it is not covered in that particular situation. What about the second one, Mr. B? Here the date is he becomes liable to pay the tax on 1st August. So that means date prior to 1st August has to be taken into consideration. So 31st July has to be taken for the date. Good. How about Mr. B? He can claim on both. Yeah. Any further answers? On both it is allowed. As I told you, it's composition scheme to regular scheme. In that particular situation, the law gives for both, subject to the rules of reducing the 5% per quarter. Now, let us look at a problem based on what we have discussed. This problem is also there. If you have your study material, 1 second, I will tell you the page number so that you can refer there also. Problem 16. Problem 16 in your study material. Page number is 8.130. 8.130. Okay. Problem number 16. So you can read there also. However, it is here also. But here it's in different slides. So sometimes you may lose track. B&D, a partnership firm in Nagpur, Maharashtra, is a wholesaler of taxable product P and product Q exempted by way of notification. This firm supplies these products only in the eastern part of Maharashtra. All the procurements, both goods and services of the firm, are from registered suppliers registered under regular scheme in the state of Maharashtra. The firm pays tax under the composition scheme. B&D company has furnished the following details with respect to its turnover exclusive of taxes and stock also exclusive of taxes. P is 60 lakhs, Q is 17,65,000 for quarter ended 30th June. For quarter ended 30th September, 50 lakhs is P, 17 lakhs is Q. Stock on 30th June also he has given. For P is 25 lakhs, 30th September 10 lakhs, 31st October 3 lakhs 60,000. Q 10 lakhs, 30th June, 30th September 2 lakhs, and 31st October is 1 lakh 20,000. Entire stock of the products P and Q available with the firm as on 30th September is purchased during the said half year, except a consignment of P 3 lakhs which was purchased in April month of the preceding financial, right? So he's telling everything was purchased in the said related period, but one portion of P of 3 lakhs was purchased in April month of the preceding financial. So immediately you should understand that this invoice is more than 1 year. So whether the credit is to be taken or not, we have to see. The said stock could not be sold in the month of October. In the current financial year, in the month of October, no purchases were made, and the products were sold with a profit margin of 20% on sales. Okay, so here you have to also have to work out the cost, because he's telling about the profit margin. The extract of the bill book shows the following details. So this bill book here is important for us to understand when it crosses the threshold and when he becomes liable for regular scheme. That is why this particular details he has given. All the amounts are exclusive of taxes wherever applicable. Compute the ITC credited to the electronic credit ledger when it exits the composition scheme and becomes liable to pay the tax under regular scheme in accordance with the provisions of 18(1)(c). Make suitable assumptions wherever required. Okay. Just try to answer this problem. You have to claim the ITC. Don't worry if your answers are wrong, because slightly tricky problem, but just try. No matter what, just try. So first in this case, you have to calculate when is the aggregate turnover crossing 1.5 crores, because on that date, the date preceding to that, we have to value the stock. So therefore, in this date preceding the date on which he becomes liable to pay the tax under section 9. So therefore, first point here, what you have to remember is you have to calculate the date on which he becomes liable to pay the tax under the regular scheme. Okay, so when does he crosses 1.5 crores is what you have to see. Again, for the purpose of threshold, both the taxable and exempt supply is to be taken. So therefore, this one is October. So turnover for June and September you have to take into consideration. So therefore, 60 lakhs plus 50 lakhs plus 17 lakh 65,000 plus 17 lakhs. So it is basically 1 crore 44 lakh 65,000. Okay. 1 crore 44 lakh 65,000 as on 30th September. Okay. Then he has given the bill book here. Then he has given the bill book here. So bill book plus 2 lakh 3,000. Okay, on 1st October plus 138,250 on 1st October again, plus 106,250 on 2nd October, and 3rd October 92,500. So 1 crore 50 lakh 5,000. So here it touches 1 crore 50 lakh 5,000. Okay. Fine. So therefore, he is crossing the threshold when on 3rd October. That is when he becomes liable to pay the tax under the regular scheme. I hope you got the point. That is the first thing to be done in this particular problem. Okay. So there, what is the date you have to take? The date prior to the date on which he becomes liable to pay the tax. And also another important point you have to remember is ITC of the inputs and capital goods not available after expiry of 1 year from the date of issue of the invoice. So here you have to see the total on 2nd October. What is the stock of inputs which are there? We have to calculate. So therefore, you know what is the stock of taxable inputs on 30th September? Is that given in the problem? So here stock as on 30th September he has given 10 lakhs. For Q, it is not relevant for us because Q is exempt by way of notification. So this is the stock which you have to take, okay, for purpose of calculating of input. So this is the stock you have to take. Then also 1st to 2nd October also you have to take. Okay, 1st to 2nd October purchases which are made, that also you have to take into consideration. So were there any purchases which is made in October? Is the question giving any details on that? The said stock could not be sold in the month of October. In the month of October, no purchases were made. This word is very important. So such lines in the problem we have to observe very carefully. If you miss those lines, it becomes very tricky for us to understand. So therefore, in October, no purchases were made. So therefore, the balance is 10 lakhs on 30th September. No purchases were made. But here, if you see here, in the month of October, no purchases, and the products were sold with a profit margin of 20% on sales. So therefore, what is he telling here? The products were sold with a profit margin of 20% of sales. So therefore, he has sold some goods from 1st October to 2nd October also. Okay. So what is the goods he has sold from 1st October to 2nd October? Again, go to the bill book. 1st October to 2nd October, he has sold 2 lakhs plus 1,33,000 plus 67,000. So totally, he has sold 4 lakhs worth of product. So this 4 lakhs worth of product for profit margin of 20% of sales. So 4 lakhs into 80%, 3.2 lakhs is the stock which is not there. Why it is not there? Because he has sold those products. So 10 lakhs minus 3,20,000, 6,80,000 will be the stock of taxable inputs on 2nd October. Now, out of the 6,80,000, if you look at the problem, it says one thing here. Consignment of product be valued at 3 lakhs, which was purchased in April month of the preceding financial year. So now you are in October, preceding financial April means more than 12 months before he has purchased that. So this 3 lakhs will not be taken into consideration. So that you have to remove. Then you will get the final stock on which the input can be claimed. So therefore, this is what we are discussing. First is take the stock of taxable inputs on 30th September, that is 10 lakhs. Okay. So in this exempt purchases, there is no question of claiming, only taxable inputs is to be taken. As we already discussed, purchases cannot be there. No purchases clearly he has mentioned. Then the cost of taxable goods which are sold between 1st to 2nd October, that also you have to take because that stock is no longer there. He has sold it. So that is nothing but 4 lakhs into 80%, 3,20,000. Then if you remove that, you will get the stock of taxable inputs on 2nd October. Then from this, you reduce more than 1 year old stock we cannot claim. That is 3 lakhs. You will get 3,80,000 on which you can claim. On this 3,80,000, assuming 18%, CGST 9%, SGST 9%, this is the ITC you are supposed to claim. I hope you understood the problem. So when you are answering the question, you have to give the explanation for each line item. Okay. If you are taking this taxable inputs, you have to give the line item very clearly. You have to give the explanation by way of working notes. Just 1-2 lines you write, but that is very important to give. Only then the examiner will understand you are working the problem based on conceptual understanding. Fine. I hope this problem is clear. Does anyone has any queries? Tricky problem. Confused a bit by giving that profit 20% of sales and other things. Clear? Find further points. Then 18 subsection 4, which talks about switching to composition or exit from tax paying the status. When the registered person was availed the input tax credit, he switches to the composition scheme, or when his taxable supplies get exempted from tax. In that particular situation, the ITC will have to be reversed proportionately based on the corresponding invoices on which credit has been availed. Invoices not available, take as per the prevailing market price. Again, this details as per the prevailing market price will be certified by a practicing chart accountant or cost accountant. These are the rules to be followed with regard to the reversal of ITC whenever you are shifting to composition scheme or exit from the tax paying status. Then the ITC involved in the remaining useful life will be reversed on a pro rata basis, taking the useful life as 5 years. As I told you, pro rata basis reversal will happen. Taking it as per 5 years, you have to see for how many years the capital asset was there. Accordingly, you have to reverse it. Then you'll have to debit the electronic credit or cash ledger by the reversal amount in case of inputs held and capital goods. Balance, if anything is still there in the electronic credit ledger, after you reverse everything, shall lapse. Cancellation of registration also requires the reversal of the ITC held in inputs or capital goods on the date immediately preceding the cancellation date. Not many people know this. We apply for GST cancellation of registration and think that everything is over. If there is any credit, you have to make sure that you pay that. Fine. What is the amount to be reversed? As I told you, you have to compare it with the output tax on the goods payable on such goods. Higher of the amount is to be paid. Then ITC also is to be calculated separately for CGST, SGST. Whatever ITC reverse is added to the output tax liability of the registered person. 18.6. Again, we told you this one, capital goods on which you have taken the ITC, you have sold such capital goods. Two things has to be taken into consideration. Whichever is higher has to be paid. ITC taken on goods reduced by 5% per quarter, or tax on transaction value. Whichever is higher, he has to pay the amount. ITC pertaining to remaining useful life again will be calculated separately. Fine. If you have seen this particular as an example also, we are just revising this as a summarized by looking at the rule. Then change in constitution of a registered person, unutilized ITC will be transferred to the new entity. Transfer or change in ownership also business also includes due to death of sole proprietor, transfer his ownership, that also is covered in this particular topic. Because sole proprietor is there, then he will not transfer it to anyone, automatically it goes to its nominee or the legal heir who is there along with that particular person. Then demerger, as I told you, the ITC will be apportioned in the ratio of the value of the new assets of the new units. Formula will be applicable for all forms of business organization, which results in partial transfer of business assets along with liability and not just demerger. Whenever the details of change in constitution is there, he will furnish that clearly in ITC 02 and submit a certificate from a practicing chartered accountant certifying that the change has been done with specific provision of transfer of liabilities. Then with regard to business organization, he clearly says that business reorganization, whenever apportionment of ITC pursuant to demerger is happening, the value of the assets of the new unit is to be taken at the state level, not at the all India level. Accordingly, he will required to file the form ITC 02 only in those states where both the transfer and transferee are registered. So these rules, just for the purpose of understanding, it is there. Not theory questions won't be asked based on the rules. Only rules where like how it is to be calculated, like that 5% per quarter. These rules are relevant because this can be asked in the examination. Fine. So let's take a short break here before we continue our discussion. And post the break, we will also look at some problems based on our understanding. We'll work out number of problems. And then if the time permits, we will also cover the concept of the input service distributor. Fine. See you in the next 10 minutes. या आप म्यूट कर लो आप. Continuation, an example here for transfer of ITC on account of the change in constitution of a registered person. Company XYZ is registered in two states of MP and UP. Value of assets is 100 crores. Assets in state of MP and UP are 60 and 40 crores respectively. It demerges a part of the business to company ABC. As a part of such demerger, assets of XYZ amounting to 30 crores are transferred to company ABC in state of MP, while assets amounting to 10 crores only are transferred to ABC in the state of UP. Total amount assets amounting to 40 crores at all India level are transferred. So here you'll have to calculate based the proportion based on the assets which are being transferred. Please try to look at this problem, and it's not a problem as such, but just that the proportion has to be done as per the transfer of assets. Total value is 100 crores, assets in MP and UP are 60 and 40 crores. So once the demerger happens, 30 crores are transferred to ABC in UP, 10 crores transferred to ABC in UP. So whatever proportion in which the assets are transferred to the demerged company, in the same proportion, the ITC shall be distributed. Fine. Then the ratio of value of assets, as I told you, will be applied to the total amount of unutilized ITC. The said formula need not be applied separately in case of all the heads. Further, this same formula will be applicable for apportionment of cess also between transferor and transferee. Total amount of ITC to be transferred to the transferee should not exceed the amount of ITC to be transferred. However, the transferor shall be at the liberty to determine the amount to be transferred under each head, subject to the ITC available in the balance. So balance of on the head is not very important as such. Whatever amount is there under each head, it is totally dependent on the respective transferor as to how we can transfer it to the respective head, but provided the balance has to be there in that particular head. So whatever apportionment formula is there should be applied on the ITC balance of the transferor as available in the electronic rate ledger on the date of filing the ITC 2 by the transferor. Same way you have to apply the apportionment formula. For the purpose of apportionment of ITC, ratio of value of the asset shall be taken on the appointed date of demerger, because every demerger will have a scheme and the appointed date will be there for that respective demerger. On that date, you have to take the value of assets has to be taken into consideration. Now let us work out some problems. On 25th August, Messrs. Agarwal and Agarwal, a registered supplier of taxable goods located in Bangalore, Karnataka, purchased one machine for 12,39,000 including IGST from one supplier of Maharashtra who issued the invoice on the same date. Messrs. Agarwal and Agarwal put the machine into use on the same date and availed IT for the eligible amount. Messrs. Agarwal and Agarwal used the machine in process of manufacture of taxable goods. However, Messrs. Agarwal and Agarwal sold the machine to Mr. Suresh Kumar of Andhra Pradesh on 20th August of next year for 7,50,000 excluding IGST. With reference to section 18.6, determine the amount payable by Agarwal and Agarwal. This is your claiming of ITC or capital good and then supplying it to others. Can you work out this one? Please try to answer this question. Simple question, not very complicated. See here, he has purchased the machine for 12,39,000 including IGST. So for the purpose of reversal, you need to know the IGST component. The moment he says including IGST, in that case, the GST is already included in this. So for calculating the GST, you have to do 12,39,000 into 18 by 118. Then after that, that is the total ITC which is there. From there, you have to reverse it at 5% per quarter. So how many quarters were there here? See, on 25th August, he has purchased. So August means July, August, September, 1 quarter will be there. October, November, December, 2 quarters will be there. Jan, Feb, March, another quarter, so 3 quarters. Then current year, he's in the next year, he's telling is selling. So April, May, June, July, August, September, 2 quarters. So 3 plus 2, totally 5 quarters will be there here. 5 quarters into 5% each. Okay, 5 quarters into 5% each. That is totally 25%. So this 1,89,000, you have to remove 25% from that. Then you will get the amount to be added for the reversal amount to the output tax liability. Then correspondingly, he says that 7,50,000 he sells it. What is the transaction value of that? So whichever is higher between the two needs to be the total amount which is payable by Mr. Agarwal. Any answers? Hope all of you are there, gone for the break and not yet come. If you're all there, it's fine. And please try to work out the problem. I just want to see what answers. Don't worry about you being wrong or correct. Just want to see whether you understood the concept. So therefore, if you see this, ITC on machinery, 12,39,000 into 18 by 118, this is a total ITC. So 5% per quarter for the period of use. Previous year, 3 quarters, 1,89,000 into 5% into 3 quarters. Then 1,89,000 into 5% into 2 quarters. For the current year, 18,900. This has to be reversed. So once you remove this, you will get 1,41,750. Okay, 1,41,750 is the ITC which you have to be paid by reversal. Duty paid on the transaction value 7,50,000 into 18%, 135,000. Whichever is higher, A or B, whichever is higher. So 1,41,750 needs to be paid by Mrs. Agarwal at the time of sale of machine. Good answers have come. Maybe some delay in the system lag, but okay, good. This is an examination question only which was asked. Then, problem number 17. Same page as that B&D problem, 8.132. 8.132, problem number 17. Yeah. XYZ Private Limited is a manufacturing company registered under GST in the state of Uttar Pradesh. It manufactures 2 taxable products, alpha and beta, and 1 exempt product, gamma. So therefore, alpha, beta taxable, exempt product, gamma. Underline these two immediately in the exam. On 1st October, while product beta got exempted through exemption notification, exemption available on gamma got withdrawn on the same date. Okay. So here what is happening? Product beta got exempted and exemption on gamma got withdrawn on the same date. Okay. Turnover exclusive. This is happened on 1st October. So the case of exempt to taxable, taxable to exempt. The turnover exclusive of taxes of alpha, beta and gamma in the month of October was 9 lakhs, 10 lakhs and 6 lakhs. XYZ has furnished the following details. Machinery U purchased on 1st October for being used in manufacturing all the 3 products, 2 lakhs, GST of 36,000. Machinery V purchased on 1st October for being used in the manufacturing product alpha and gamma, which is again 1 lakh. Machinery W purchased on 1st October for being exclusively manufacturing beta, 3 lakhs, GST also is given. Machinery Y purchased on 1st October 4 years ago for being exclusively used in manufacturing beta. From 1st October, it will also be used for manufacturing gamma. So that is 4 lakhs, 72,000 GST. Machinery Z purchased on 1st October 2 years ago for being used in manufacturing all the 3 products, 3 lakhs, 54,000 GST. Same way, raw material for alpha on 5th October, 1.5 lakhs. Raw material for beta on 10th October is 2 lakhs. Raw material for gamma purchased on 15th October is 1 lakh. So these are the multiple types of machinery raw material. Machinery capital goods, raw material inputs are given for manufacturing all of this. We have to calculate comprehensive problem. Calculate the ITC credited to the credit ledger, aggregate value of common credit attributable to exempt supplies, GST liability of the company through the electronic cash ledger. Okay. Please try to work out the problem. I'll give you 5 minutes. Again, don't worry about it being wrong, correct, or not. Just try whatever comes to your mind, try to do it. Sir, in exams, do we need to write the provisions of the section exactly as it was? We can use our own words. See, this phrase own words is a very, what do you call? Interesting phrase. Own words can be anything. I may have my own words, you may have your own words. Provisions of the section, it is better you write exactly apart from some grammatical things here and there which don't change the meaning of the section is fine. But as far as possible, try to use the language given in the section. Because own words, what are exactly own words? It is not standard for each person. So it is preferable you write the exact provision. Of course, if you don't remember, rather than not writing anything, better you write as per the own words. You try to remember the matter in the section. Don't have to remember the section numbers, circular numbers and all. But matter in the section, you try to remember. So here what you have to do, the guidelines to do this step, you can write the guidelines wherever your notes are in. First, you have to calculate the ITC credited to the credit ledger. How do you calculate the ITC which is credited to the credit ledger? First, you take the ITC credit, raw material, the common credit, fine. Once you get the total ITC common plus regular input tax credit, you go for calculation of the common input tax credit. Once you get the common input tax credit, you have to go for the common credit attributable to exempt supplies. Then we will come to the payment of GST liability. Fine. So therefore, let us see what are the various points here. First one, if you look at the problem, he says machinery you purchased on 1st October. So here what exactly is happening? He is manufacturing totally 3 products. 1st October, what is happening? Exemption got withdrawn for beta, and for gamma also beta got exempted. Sorry, beta got exempted and gamma got taxed. So machinery U is being used for manufacturing all the 3 products. So therefore, if it is used for manufacturing all the 3 products, that means the ITC, which is used for both the taxable and exempt supplies, will be credited to the electronic credit ledger. It will be denoted as A as per rule number 43. Fine. So therefore, this machinery U total amount, that is 36,000. That is 36,000 shall be taken into consideration. How did you get this 36,000? You go to the problem. Here it is mentioned. Machinery U 36,000. Next, machinery V purchased on 1st October for being used in manufacturing alpha and gamma. So if you see here, exemption available on gamma got withdrawn. So that means gamma also became taxable. Gamma also became taxable now. So therefore, this is now this machinery which was purchased Okay, on 1st October, so if you see the date, exemption got withdrawn on the same date. So on 1st October, you are purchasing machinery capital goods, which are being used for both alpha and gamma. And post 1st October, both alpha and gamma are chargeable to tax. So therefore, 1 lakh into 18,000, this also will be created in the electronic credit ledger. Fine. Then machinery W purchased on 1st October, exclusively used in manufacturing beta. As I told you, beta got exempted through exemption notification in the question. So this will not come. Why? Because this capital goods is used exclusively in manufacturing and exempt supply. Then machinery Y purchased on 1st October, 4 years ago, for being used in manufacturing beta. From 1st October, such machinery will also be used for manufacturing gamma. So here what is happening? From 1st October, this machinery Y is being used for both taxable and exempt supply. Why? Because now presently beta at that point of time was taxable. Now it became exempt and gamma is now taxable. So it is used for both exempt and taxable supply, machinery Y. But prior to that, it was used exclusively for taxable supplies because at that point of time, beta was taxable. Okay. If you look at this machinery Y, it was purchased on 1st October 4 years ago. And that point of time, beta was chargeable to tax. So since beta was chargeable to tax and this was purchased at that point of time, for machinery Y, you would have already claimed the input tax credit at that point of time. So there is no point in claiming once again. So therefore, for machinery Y, nothing will be claimed because it is already claimed at that point of time. Then machinery Z purchased on 1st October 2 years ago for manufacturing. Machinery Z purchased on 1st October 2 years ago for manufacturing all the 3 products. So 2 years ago, this machinery Z was purchased. At that point of time, it was used for both the taxable and the exempt. At that point of time also, the same rule would have been followed and it would have been created in the electronic credit ledger. So now also nothing needs to be done for machinery Z. So machinery Z also nothing will be claimed. Now, raw material used for manufacturing alpha purchased on 5th October. So on 5th October, he is purchasing the raw material. In this particular situation, raw material is, one second. Raw material for manufacturing alpha. So alpha, is it taxable? Alpha is very much taxable. Alpha is very much taxable. So therefore, the raw material used for manufacturing alpha as it is will be taken in your credit ledger. So therefore, this 27,000 will be straight away taken. The raw material used for manufacturing beta purchased on 10th October. Again, now this is exclusively used for the exempt supply, which is beta now. So this 2 lakhs, this 36,000 also will not be taken into consideration. Then raw material used for manufacturing gamma purchased on 15th October. So for gamma has become a taxable product. So therefore this 18,000 will be totally allowed as a tax. Fine. So therefore these are the total which you have to take. First we will calculate the ITC which is credited to the electronic credit ledger. So all those machinery raw materials we have identified and total of 99,000 gets credited to the electronic credit ledger. Till here everyone are clear? If everyone are clear till here, then I will proceed for the next step. Just in 1 minute, kindly tap a message on the query link that if you are able to follow. Then I'll go to the next step. Done. Okay. Why I'm asking you is a slightly big problem. So I just want to be clear step by step. Now we come to the next step for calculating the common credit. What you have to, so for common credit, what all has to be taken? First of all, this Machinery you purchased for all the three products. So for common credit, you have to take this particular point. And machinery Z, which is purchased on 1st October for being used in manufacturing all the three products. This was taken at that point of time. So for common credit, you have to take this. And then input tax credit claimed on machinery Y. Okay, machinery Y, you have claimed the input tax credit at that point of time. So this also for more than taxable and exempt supply. So this also should be taken into consideration. Yeah. So therefore, when it comes to common credit, value of A, machinery U, which is purchased on 1st October, 36,000. Value of A for machinery Z purchased on 1st October, 2 years ago, for both affecting both the taxable and exempt supplies. Then ITC, which you have claimed on machinery Y 4 years ago for affecting taxable supplies, but used for affecting both the taxable supply for first current. So these three are the total common credits which you have to take. That is your TC. So this, what we are doing, for what purpose we are working out this? We are working out this common credit so that we are able to identify the credit which is attributable to the exempt supply. That is why we are working out this common credit. Okay. So once you get the common credit, you have to work out the common credit attributable to exempt supplies for the month of October. So therefore, as I told you, 60 months is the life what you have to take. So common credit is 1,60,000 divided by 60, 2,700. So in this month, 2,700 to the power of exempt supplies you have to attribute. So what is the exempt supplies? If you see, turnover of alpha, beta and gamma is 9 lakhs, 10 lakhs and 6 lakhs. Okay. So 10 lakhs is the exempt product here. So coming back here, 2,700. One moment. 2,700. Okay. And what is the total turnover? It is 9 lakhs, 10 lakhs and 6 lakhs. So 25 lakhs. And beta is now exempt. So 10 by 25. Okay. Here 10 by 25. Here 10 by 12 has come. This should be 10 by 25. Okay. So 10 by 25 into 2,700. 1,080 is the common credit which is attributable to the exempt supplies. So once you get the common credit attributable to exempt supplies for this particular month, we can calculate the GST liability. What is the GST liability? Turnover of alpha 9 lakhs into 18%, 1,62,000. Beta is now exempt, so nothing. 6 lakhs into 18%, 2,70,000 is the IGST on outward supply. From this, what is the common credit attributable to exempt supplies? Once you find out that, you have to add it to the output tax liability. So you add it to the output tax liability. Then you reduce the ITC what you claimed. ITC what you claimed is the first point. You reduce the ITC what you have claimed, and the balance IGST payable is 1,72,080. Sir, why machinery? Why input tax credit has not been taken? It is used for gamma also. Let me come back to the question. Machinery Y, you're talking about this one, why it is not being taken. Machinery Y was purchased 4 years ago. If it was purchased 4 years ago, at that point itself, the credit would have been taken. That is why we are not taking now. I hope you got the clarity. It was purchased 4 years back. So at that point of time also, it was used for manufacturing beta at that point of time. Beta was taxable then. So you already claimed the credit at that point of time. So no question of claiming one more time. It won't come here, but it will, in this particular, in the common credit, it will come, because common credit you are working out only for the purpose of removing it per month, how much it pertains to exempt supply. For calculating that only you are doing. So I hope that is clear. Fine. So that was your problem based on this one. If no more questions on this, we'll go to the next section, section 20, that is your input service distributor. How to calculate exempt supply? Here we are seeing only for October. So October, for the purpose of October, gamma is no longer exempt, beta is exempt. That's all. So for the purpose of the question, it all relates to October month. So 1st October, exempt became taxable, taxable became exempt. So whatever is there exempt for 1st October month, you have to calculate that. Now we come to the concept of input service distributor. Section 20 of the CGST Act 2017 talks about how the input service distributor should distribute the credit in this particular situation. So this section set forth the way by which the input tax credit for services. Again, input service distributor talks only about services, not for goods. For goods is very clear. Wherever the goods go, to that extent you can claim the respective credit. So many expenditure are there, like internet services, broadband services, transport services, etc., wherein the same entity having the same PAN has multiple GST registrations, and the section can set forth the way in which it is distributed, the credit is distributed. So what does the section say? Says is there the input service distributor shall distribute the credit of central tax as central tax or integrated tax as integrated tax or central by issue of a document containing the amount of input tax distributed in such manner as may be prescribed. Fine. So therefore, input service distributor will first distribute whatever central tax is there. He will distribute that credit as central or integrated tax, because even integrated tax can be available as a credit, and outside the state it will be IGST. IGST he has to distribute as IGST or central tax by issue of a document. In the document, he will clearly mention what is the ITC being distributed in such manner as may be prescribed. So that is your section 20 subsection 1. One more doubt now for that problem. Y and Z, since purchase long at that time, ITC will be taken proportionately for. Then why is it considered now itself for reversing the tax credit? Because it is still there. Because the machinery Y and Z are still there in existence and still used for that. So we are calculating for the common credit attributable to exempt supply. Okay. For the purpose of common credit attributable to exempt supply, we are calculating that because it is still being used. That is the main question. Let us go back there once. See, it is still being used. You are getting the common credit, and since the useful life is 5 years, you divide it by 60, and per month you are attributing to the exempt supplies. Because capital goods, though it is purchased long ago also, the method of reversal of credit is spread over the period of 60 months, as given in rule number 43. That is why we are taking it now. Why state tax is not written by distributed as input ISD? Why? Because input service distributor is technically always the head office. Mostly it is the head office of the person. So when he allocates it to different branches, the input service distributor will allocate only to the branches outside the state. Because within the state, anyways, the credit will be taken. Since it is given outside the state, it is distributed as IGST. Fine. So the input service distributor the credit will be distributed subject to the following conditions. The credit will be distributed to the recipient based on such document containing such details as will be prescribed. Again, whatever amount you are supposed to distribute shall not exceed the amount available for distribution. So whatever example I'll tell you for input service distributor, a broadband connection for 5 lakh rupees worth has been purchased by the office whose registered office is in New Delhi. This broadband has been used for all the states like Telangana, Gujarat, Chhattisgarh, etc. So therefore, we have to see what is the credit. So 5 lakhs is the broadband cost, 18% of that, assuming it is 90,000. 90,000 is only available for credit. So whatever credit you are distributing should be maximum 90,000. You cannot increase the amount of credit which is available for distribution. You cannot distribute more than what is available. That is an important point under 20 subsection 2. The input service ISD credit to be distributed subject to the following conditions. The credit of tax paid on the input services attributable to more than one recipient shall be distributed to whom, and distribution shall be pro rata on the basis of turnover in the state or turnover in the union territory of the recipient during the relevant period to the aggregate of the total turnover of such recipients to whom it is attributable and which are operational in the current year during the set relevant period. So how should the credit be distributed? The credit shall be distributed on a pro rata basis on the basis of the turnover in that respective state. On the basis of that particular turnover only, the credit will be distributed and which are operational during the relevant period. Relevant period means what? If recipients of credit have the turnover in the preceding financial year, is the said financial year. If they do not have turnover in that financial year preceding the year to which the last quarter for which the details of the turnover are available, previous to the month during which the credit is to be distributed. So first you have to see how to apportion the credit. You will apportion the credit based on the turnover. First you will see the turnover in the financial year preceding the year where the credit is to be distributed. If there is no turnover in that financial year, etc., the last quarter of the details for which the turnover is available, you have to take. Recipient of credit means the supplier of goods or services or both having the same PAN number as that of the input service distributor. Basically, in simple words, is nothing but the distinct person. If you have one GST registry, one PAN number and multiple places of business, you have to open a separate GST number. So it will be the same PAN number. An input service distributor also will apply for a separate registration, which is known as an ISD registration. And once he registers only, he can do this apportionment of input tax credit. Right? Sometimes what happens? If the input service distributor distributes the credit in contravention of the provisions contained in section 20, which results in excess distribution of credit to one or more recipients of credit, in that case, the excess credit is to be recovered from the recipient of the credit along with interest. So whenever the credit happens in contravention of the provision, whatever credit is available, if more than that the credit is being distributed, then in that case, the excess credit is to be recovered from the recipient along with the interest. And for determination of amount to be recovered, these provisions of 73 or 74 will be applicable. So why this concept of input service distributor is there? Can anyone tell me? Why this concept of input service distributor is there? What is the reason for that? What is the logic of having this? Can anyone tell me? No, see, you will distribute the SGST as IGST. It's not like that SGST cannot be distributed. The SGST, what you see, head office will be there. Head office recruits a vendor for the payment of CGST and SGST. Whatever credit is there, the head office, this credit, they will distribute it to the branches as IGST. Fine. So, though the main invoice is SGST, when it ultimately goes for the purpose of distribution, it becomes the IGST. Yes, for common purchase of goods or services to maintain the flow of input tax credit. Okay. So mainly what happens is Sometimes the head office will be in one place and the units will be at other places or registered separately. The head office would be procuring some services which are for common utilization of all the units. Since the common inputs is there, definitely it is very important that the credit should be apportioned between all the consuming units. So therefore, ISD enables proportionate distribution of credit, and concept of ISD is a legacy carried from the service tax regime. Service tax regime also, this input service distributor mechanism was there. So it is not a new concept. In service tax also the same problem was there, wherein different people were located in different places. So therefore the credit of service tax used to be transferred to all those persons. Then some more points for ISD is he has to get himself registered under GST, even though they are registered as a normal taxpayer. So therefore, if a head office is there, he will have a regular GST registration. Apart from regular GST registration, he will also have an ISD registration. Fine. And since the services related to other locations, the corresponding credit should be transferred to such locations as the output services are being provided there. Arithmetical accuracy should be maintained. Credit distributed will not exceed the credit which is available for distribution. What are the rules to be followed? If only one recipient is there, straight away distributed to him. More than one recipient is there, on the basis of turnover, you have to distribute. Example, ABC Limited, a confectionery manufacturer, has paid bills of advertisement company amounting to 24 lakhs for advertising campaigns of two varieties of cakes, which are manufactured at separate locations in Pune and Bangalore. The company had a total turnover of 112 crores in the previous financial year. Turnover of the Pune unit was 5 crores. Turnover of the Bangalore unit was 10 crores. Please compute the ITC which is attributable. Can you try to work out this problem? Simple problem for understanding purpose. So at 24 lakhs is there, which are manufactured at separate locations in Pune and Bangalore. Company turnover 112 crores. So ITC is attributable only to Pune and Bangalore. So turnover of Pune and Bangalore is important here to be considered. Turnover of 5 crores of Pune and Bangalore is 10 crores. Aggregate turnover should be 15 crores. So 1:2 ratio, 5 by 15 into 24 lakhs. So 8 lakhs will be distributed to Pune ITC and Bangalore will be given 16 lakhs. In case excess is distributed, who is required to reverse the excess credit? Whether the branch which receives the input or the head office. Definitely, in this case, if excess is distributed, IHD would have stated excess in his portal. He has to reverse that. And also, in case that particular branch is getting more than what is required, they will also have to reverse from their side. A problem based on ITC. XYZ Limited, having head office at Mumbai, is registered as ISD. It has 3 units in different cities, in different states, namely Mumbai, Jabalpur, Delhi, which is operational current year. Mr. XYZ furnishes the following information. CGST paid on services used only for Mumbai unit 3 lakhs. IGST, CGST, SGST paid for all the units 12 lakhs. Total turnover for the previous financial year are as follows. Please determine the ITC. Total of 3 units 10 crores, Mumbai 5 crores, Jabalpur 3 crores. Okay. Determine the credit to be distributed. That is the question. Okay. Determine the ITC. Here it is there. Case excess is distributed at the time of interest. Yeah, definitely interest will be paid. So here what is happening? XYZ has the registered of head office registered as ISD. 3 units is there in different places: Mumbai, Jabalpur, Delhi. Operational the current year. XYZ Limited furnishes the following information. CGST payable on Mumbai unit is 3 lakhs. So therefore, only for Mumbai unit, the CGST 3 lakhs will be available. Credit available only Mumbai. Okay. Then IGST, CGST and SGST paid for services used for all the 4 units. So 12 lakhs. So this one is services used for all units. Okay. Now turnover also is given. What is the ITC which you can claim? Okay. So here what is happening? The credit to be distributed. See, credit, since use credit of 3 lakhs to be distributed only to Mumbai. Only to Mumbai. Because CGST paid for services related to Mumbai on. Okay. Then further IGST is how much? 1 second. Further, this one IGST, CGST for all units 12 lakhs. Further IGST, CGST and SGST is rupees 12 lakhs for all units. So ITC to be distributed on basis of turnover. Okay. So what is the total turnover here? Total turnover of all the 3 units is telling 10 crores. Mumbai 5 crores. Jabalpur is 3 crores. Fine. So 5:3:2. Okay. 5:3:2. Mumbai 5:3:2 is, what is the total? 3,60,000. Jabalpur is 3,60,000. And the next one, Delhi. 2 by 10 into 10, which is 2 by 10 into 12, which is 2,40,000. 2,40,000. Okay. So if you see the total, Delhi 2,40,000, Jabalpur 3,60,000, Mumbai 6 lakhs here and 3 lakhs on top. So therefore 9 lakhs is Mumbai. So I hope you got the point. Okay. This is a problem based on input service distributed. Summarizing procedural aspects of ITC distribution, ISD is to issue an invoice as per rule for 54.1. Credit note also to be issued for reduction of ITC. Invoice and debit note, you should have all of these details. Name, address, and GST number of ISD and recipient of credit. Serial number, date of issue, amount of credit distributed, signature of ISD or the authorized representative. Okay. Also, for banking company and financial institutions, the relaxation is given. If the ISD is a banking company or financial institution, the document for distributing the credit need not be serially numbered because multiple branches will be there. Very difficult for him to distribute everything. ITC available for distribution in a month is to be distributed in the same month. So in which month ever the ITC is available, for the same month the distribution has to be done. Details of distribution of credit and all ISD invoices should be furnished by the ISD in monthly GSTR 6 within 13 days after the end of the month. So whatever distribution are there, you have to and details and all the ISD related invoices issued should be furnished by the input service distributor in monthly GSTR 6. This is the GSTR 6 return which is there. On this, he has to file all the invoices within 13 days after the end of the month. ISD cannot accept the invoice, the tax on which he has to pay on RCM. Again, invoices on which reverse charge mechanism is applicable, the input service distributor cannot take that because it is not relevant in any way. Because the invoices, whatever has to be paid under RCM, the pay amount is paid directly by the recipient of supply. Then debit note, additional distribution of ITC is there means you have to give a debit note, and if any ITC reduction is there, you have to give a credit note. Any excess tax is distributed will be recovered with interest along from the recipient. Fine. That was your concept of ISD. Now let us look at more problems. Xenon Private Limited Agra is a registered supplier engaged in the manufacture of taxable goods. Goods valued at 10,50,000 were supplied by the company to Fresh Bite Private Limited, a registered supplier located at Ferozabad, without the cover of an invoice with fraudulent intent. Okay. Since company evaded tax by not issuing the invoice, show cause notice was issued by the proper officer requiring the company to pay tax at 12% and applicable interest. The company paid the tax, interest and penalty after the order was passed. Examine the ITC entitlement of Fresh Bite Private Limited. Please try to answer this. Yes, you can assume that. You can make that assumption, Sriram. There is no problem. You can definitely make that assumption because the question was very brief and didn't give much clarity. Go to the question here. CGST 3 lakhs, services used for all the units 12 lakhs. But since he is given very clearly services used only for Mumbai unit, maybe the 3 lakhs, it won't appear good if you say that 12 lakhs is 3 lakhs is a part of the 12 lakhs. Of course, you can give that assumption saying that your interpretation, but since it is very clearly given only for Mumbai unit, it doesn't have a chance of being included in the 12 lakhs because it says paid services for all the units. So better to treat them separately if you ask. Can't avail ITC as it is fraud. You have to give the section reference also. If you don't remember the section reference, at least provisions of the CGST Act 2017 relating to input tax credit as per 17 subsection 5. If any amount is paid by way of fraud tax, the input tax credit will not be allowed. 17.5 or say section 17 of the Act. Okay. 17 subsection 5, taxes paid under 74, 120, 130 is not available as ITC. Further, also, Rule 36.3 says that tax paid in pursuance of order where the demand has been confirmed on account of fraud, willful misstatement cannot be availed as the ITC. So therefore, since he has paid by virtue of section 74, Fresh Bite cannot avail the ITC of such tax. Next, Flamingo Limited is an airlines providing passenger transportation services by air. The company offers meals of premium quality to passengers on board the aircraft. The value of such meals is compulsorily included in the price of the ticket. Company avails outdoor catering services of Dhaniyaram Private Limited for providing such meals to customers. Whether Flamingo can claim ITC on such outdoor catering availed by it. problem based on 17 subsection 5. Any answers? Any answers? Yes, it can claim ITC for further supply. The wording is very, very important. You have to give the exact wording. Here, your own words will not work. You have to give the exact wording. You have to say that though the nature of supplies of catering service, which is restricted under 17 subsection 5, as per the proviso given, it is very clearly mentioned that the catering service, if it is used for the further supply of the same service, either by way of mixed or composite supply, then the credit is available. This is how you have to very clearly mention in the exam. So therefore, ITC can be claimed because it is a catering service, but it is used for further catering service only. So therefore, since the nature of further supply nature and the input nature is the same, you can claim the input tax credit. Next one, Jumbo Sales Private Limited, supplier of ready-made garments, announced buy one get two free offer on men's t-shirts on Diwali to boost the sales. You are required to advise the company on availability of ITC in respect of inward supplies used in relation to such supply. Jumbo Sales question, anyone? Yeah, so as we discussed in today's class only, this buy one get one free offer, buy one get two free offer, buy one get 10 free offer, all these things also, it is basically, as I told you, it is supplying 3 products for a single price. Technically, it is not a free supply. Though the offer mentions free, technically it is not a free supply. In this case, it is selling three products for the price of one. So maximum you can say that it is being sold at a heavily discounted price. So therefore, in this case, ITC is definitely available as clarified. If you remember the circular number, you write. Otherwise, you just write as for the clarification issued under the provisions of the CGST Act. Fine. Next, garment factory receives a government order for making the uniforms for a commando unit. The supply is exempt from tax under special notification. The fabric is separately procured for the supply, but thread and lining material for the collars are the ones which are used for other taxable products of the factory. Turnover of the other products and the exempted uniforms is 4 crores and 1 crore respectively. ITC on thread and lining material procured in July is 5,000 and 15,000 respectively. Calculate the eligible ITC on thread and lining material. Please try to answer this one. Common ITC related problem. So therefore, here if you see, exempt turnover is 1 crore, other products turnover is 4 crores. Okay. So total turnover, if you see, it is 5 crores. So what is the common credit which is there? Thread and lining material for 5,000 and 15,000. So if you see, fabric is a thread and lining material are used for the collars are the ones. Collars, see here it says supply is exempt from tax, fabric is separately procured. By thread and lining material for the collars are the ones which are used for other taxable supply, the products. So very trickily given, very trickily given. So therefore, this clearly implies that this thread and lining material are used for both the taxable supply as well as the exempt supply. Why it is used for exempt supply? Because it is used for the collar, and he is clearly saying that it is used for other products also. So therefore, both these 5,000 and 15,000 are used for both the taxable and the exempt supply. So therefore, the common credit here is 20,000. Exempt turnover, you know, is 1 crore. Taxable is 4 crores. So common credit attributable to exempt supplies is 20,000. Okay, this 5,000 plus 15,000, 20,000 into 1 divided by 5, that is 4,000. That is 4,000 rupees. 4,000 rupees. So that is the credit attributable to exempt supplies. Ineligible credit of whatever is that amount, 4,000, which is attributable to exempt, ineligible credit will be reversed in GSTR 3B, and eligible credit will therefore be 16,000 rupees. That's 20,000 minus 4,000. Credit attributable to exempt supply is common credit into exempt turnover by total turnover. Common credit is 20,000, which is nothing but for that lining and thread. Ineligible credit to be reversed 4,000. Eligible is 16,000. I hope you got the clarity. Good. Next question. A registered supplier of taxable goods supplied goods at 2,24,000, including the GST, CGST 12,000, SGST 12,000 to Mohan Limited under forward charge on 15th August, for which tax invoice was issued on the same date. Inputs were received by Mohan Limited on 15th August. Mohan Limited availed a credit of 24,000 on 20th September by filing GSTR 3B for August 1. However, he did not make any payment to such supply along with the tax thereon. Is Mohan Limited eligible to avail such supply? Discuss ITC provisions if he makes the payment of 2,24,000 to the supplier on 18th March of the next financial year. Please try to answer this problem based on timelines of claiming the input tax credit. Any answers for this one? How much he can claim the credit, when he can claim the credit, and when he has to reverse the credit. This is all the various top concepts which are being handled in this problem. So here what is happening? Registered supplier supplied goods worth 2,24,000 to Mohan Limited. Forward charge. That means Mohan has paid the GST. Okay. The inputs were Mohan is supposed to pay the GST. Inputs were received on 15th August. Okay. Mohan availed the credit of 24,000 on 20th September by filing 3B. August month 3B, he filed 24,000. Let us assume it is also reflecting in the 2B and he has filed. However, he did not make the payment for such supply along with the tax. Is Mohan eligible to avail? What is the answer for this one? First one. Is Mohan eligible to avail? So what is happening here? Here, first thing he will be available. Here he is eligible. Yes, he is eligible because payment of tax from recipient to supplier should happen within 180 days. So here what is doing? He is eligible to avail the ITC. So presently he has not paid, but still he has the time. So he can definitely claim the ITC. If he makes the payment of 2,24,000 on 18th March, what is this? So you have to see the date of invoice. What is the date of invoice? Date of invoice is 15th August. 15th August. So what are the number of days which you have to cover? August 16 days plus September 30 plus October 31 plus November 30, December 31, January 31, February year is not given. So let's assume 28. Okay, 28 days. So just take how many days has happened? 46, 77, 107, 138, 169 plus 28, 197. So therefore in February, okay, in February 180 days is crossing. Okay, in Feb 180 days has elapsed. So therefore he has to reverse the ITC along with interest under section 50 subsection 1. Okay, understood? So Feb 180 days is elapsed, so therefore he has to do. So therefore when he makes the payment on 18th March of the next financial year, so the moment he makes on 18th March, when the payment is made, again he can reclaim of the credit. Reclaim of credit can be done in the GST return for the month of March once the amount has been paid. Okay, I hope this question is also clear. Everyone understood? Okay, next question. So therefore, this is the answer for this. Payment of value of the goods along with the tax is not a prerequisite at the time of availing the credit, but he has to pay within 180 days from the date of the invoice. If he fails to do so, the 24,000 ITC will be added to the output tax liability with interest. Interest will be 18% per annum from date of availing credit till the date when it is added to the output tax liability. If he makes the payment of 2,24,000 next month, that is after the expiry, he can avail the credit of 24,000 while filing the GSTR 3B for the month of March. Constructions procure cement, paints, iron rods, etc. for construction of commercial complex for one of its clients. ABC availed maintenance and repair services from Jaggi Motors for a truck used for transporting finished goods. Try to answer this. First one, MBF, works contract service for construction of foundation on which machinery can be mounted permanently. So here, machinery, what is there? So whether this is plant and machinery, look at the explanation given. It clearly says plant and machinery covers the foundation permanent machinery. It has all the characteristics of a plant and machinery only. So therefore, if the works contract is towards construction of plant and machinery, definitely the input tax credit is allowed. Only if the works contract service is for construction of a building other than plant and machinery, only then it is not allowed. So therefore, here it will be allowed since it is a plant and machinery. ITC allowed since it is in the nature of plant and machine. Then Shah & Constructions procured cement, paint, iron rods and services of architects and interior designers for construction of commercial complex for one of its clients. What about this one, second one? Correct. Shah, if you see, he is technically the cement purchase architects, interior designs are not allowed, but he is using for commercial complex of one of its clients. So here what is happening here, the works contract services are being used for supply of further works contract services. Therefore, ITC is allowed. Then ABC Limited availed maintenance and repair services on Jaggi motors for truck use for transporting its finished goods. 17 subsection 5, when it speaks about motor vehicles, it restricts only goods for transport of passengers. So therefore, this also will be allowed. Okay. Any confusions here? Please ask. Okay. Done. Now kindly go through this problem and also check, try answering this as a revision problem for you. Let us go through the question first. X, a manufacturer of roofing sheets, he has 1,60,000 as opening balance of ITC for June month. Towards following information. First is input tax on raw materials is 40,000. Raw material used for making both taxable and exempt supplies credited to electronic rate ledger. Input on catering services, harvest caterers in connection with house warming service 10,000. Outdoor catering blocked, not a supply as per closing furtherance of the business. I stated that the last sentence is. The hints are here, so I'm just deleting them. So these are the inputs on raw material held exclusive manufacture of exempt supply, cosmetic plastic surgery of manager. Total taxable turnover is 60 lakhs exclusive of tax. Compute the ITC credited for the month to electronic rate ledger and net GST payable. Fine. Please try to work out this problem as a homework and revision problem. We will discuss the solution in the coming class. Fine. So any further queries here before we wind up today's session? No. It is allowed. I'll take back to the I'll go back to the section 1 minute. I'll go back to 17.5 Kaushik so that you get clarity on that. Works contract service when supplied for construction of immovable property, except when it is an input service for further supply of works contract service. This is where that's our construction. So therefore, it comes under this following exception. Okay, so that is why it is allowed. I think you got confused with this one, what is mentioned, goods or services both for construction of immovable property, including when such goods or services are both used for furtherance of the business. Don't get confused. This is different and that is different. Fine. So this one is basically your construction of immovable property on your own account, or you're used for furtherance of business means you're constructing the building so that you can use it as an office. You're constructing a building so that you can use it as a factory. All that is covered. So I hope you got the clarity on this. Is it clear, Kaushiki? If it's not clear, I'll again explain. Wait. Let me again share the PPT. 1 minute. Yeah. Now, you have the question in front of you. What does the question say? 1 second. Just opening the question parallelly, because here if I open again, it's on a different slide altogether. Shah and Constructions procured cement, paint, iron rods and services of architects and interior designers for construction of a commercial complex for one of its clients. So cement, paint, iron rods and services of architects, they come under works contract service only. Once he procures that as a works contract service, he is using it for construction of a commercial complex for one of its clients. So he's procuring the works contract services and he is using it for further supply of works contract service. Using for further supply of works contract service, that which is pretty much come in 17.5C. You are telling it comes in 17.5D, but it will not come in 17.5D. The reason why I am telling you, this is goods or services for construction of immovable property on his own account. That means other than plant and machinery, on his own account. That is, I am constructing the respective, I am procuring the goods and services for construction of a building for myself. It can be my residence, it can be my office, including when such goods or services or both are used for furtherance of business. Means what? Furtherance of business means it's don't implement as if I'm purchasing that and selling that or something. It's not that. It's for the purpose of business. Example, I am constructing a factory for my manufacturing unit. I need a factory building. I'm constructing that building. What is it used for? It is used for furtherance of business. So that is not allowed. Don't get confused with that and with C and D. I hope you got the distinction now. Clear? Wonderful. Very good. Thank you very much, sir. Wonderful. So thank you for your kind words, Sriram. I hope all concepts are clarity, because input tax credit, even if I wake you up in the middle of the night and tell you explain rule number 42 or 43, you should be able to answer it. Okay. So let's conclude this session now. Any further queries, please feel free to post it. And our next class will be tomorrow itself. Tomorrow at 6 o'clock, we will continue working of the problems, and we will also cover the job work related procedures. With this, we come to the end of the input tax credit. Tomorrow's session and another session on Wednesday will conclude the entire huge topic of input tax credit. Thank you very much. Please revise all the concepts clearly till we meet tomorrow at 6 p.m.